Ashish, thank you so much for your time. 28.2 billion shillings worth in the ESG First Fund. Why ESG First? Why this region? Whom are you targeting?
The ESG First Fund is, as you mentioned, a 28 billion shillings fund, about 250 million US dollars, investing in mid-sized businesses across Africa and Asia. And the nucleus of the conception of the fund was around the practice of environmental, social, and governance, which is short form for ESG, which is a requirement for businesses looking to export into the developed markets, where the application of it is getting stringent by the year. And if you think about it, we as Kenya is a massive, significant exporter of products, particularly fresh fruits, vegetables, tourism, you name it. We're big exporters, and it's a major earner for countries like Kenya. If we do not keep up, as the industry does not keep up with ESG standards that's getting regulated in the West, we would lose out in that big opportunity for exporters out of the country. And therefore, the thesis of the fund is to help businesses improve their ESG standards, and in doing so, becoming a lot more successful in the export market, and therefore grow within our own countries as they become more successful exporting. Remember, the global export market is worth trillions of dollars, right? Much bigger than the economy of Kenya or Tanzania or Uganda in its individual right. And therefore, for us to have a meaningful stake in that export industry would do us a lot better than trying to just work excluding that.
So tell me, Ashish, you did mention targeting the mid-cap entities, and by way of ticket size, what sort of deal size would you be looking at? And why I'm asking that question is because, given the sort of geographical area you're looking at, what is mid-cap in some market in Asia may not necessarily be mid-cap in Africa here.
Yes, very good, very good. That's correct. And so for us, we're talking about an investment size of anywhere as low as 200 million shillings. That's about $2 million, all the way up to $5 million. Our sweet spot's going to be between 3 to 5 million US dollars per transaction. Obviously, in the larger businesses, we can go significantly larger as well. So mid caps for us are typically businesses that are doing, less than $50 million, I would say, but above $3 to $5 million. So it's a very wide range, and we've done that on purpose, right? Because you have some exporters or some businesses in Kenya that are in the smaller scale of the small enterprises, as opposed to the mid enterprises that we do want to enable. And they typically have employees, anywhere less than 250 people, right, or thereabout. But the application of these guidelines are not cast in concrete. So it's about us being practical about it and saying, are you a business that is in the export area? Can you do with our help? Can you do with our value addition? And our value addition is really around a bunch of professionals that we have within the fund that are specialists in ESG across different sectors. And if you can do with our value addition, how can we help you to grow better, right? So the definition of mid-cap is reasonably large. What we are not likely to do is, invest into a Safaricom, right? I mean, they don't need our money, but B, there's very little we can do that's going to help them in their value accretion.
Fantastic. And when you deploy capital, what sort of mix would you be looking at in terms of debt, equity kind of arrangement? And if it's equity, what sort of a stake would you ideally be targeting?
Yeah. So the fund is can invest across the capital structure, right? We don't have to do debt, we don't have to do equity. We can do a combination of both, or we can take what we refer to as risk capital, meaning that it's a debt type structure, but it's actually equity, so that businesses do not have to worry about issues around dilution or other shareholder rights, etc. What is so we are looking, if we are taking equity stakes, we're looking at primarily minority stakes in businesses. But what we will be looking at doing is being an active participant in the business that we invest in, right? So it's not, I'm contrasting ourselves to banks, right? So we are, in fact, essentially investing in your business. We will be actively involved in setting or helping you set some of the strategy of the business, particularly around sales, exports, and very much around the environmental, social, and governance frameworks that the businesses deploy and employ and deploy. and how can we improve that standing so that our businesses are very competitive on an international stage.
Still on deployment, are you sector agnostic or as a fund, or how are you then approaching this?
We're sector agnostic. For countries such as Kenya or East Africa, or put it the EAC community, there's obviously going to be a bias towards some of the sectors that we are, strong at. So, agriculture comes to mind. We're a significant exporter in fruits and vegetables. Apparels come to mind, right? So fabric's a big area for us as the global supply chain moves away from having too much dependency on, for example, China or just India into a global supply, and East Africa is positioned extremely well for that. And then we want to work on the supply chain in itself, right? The globe, because to be a efficient exporter, you need a efficient supply chain. So if I always point towards countries like Singapore or Hong Kong, which have a very efficient, or the UAE for that matter, which have a very efficient supply chain embedded within its infrastructure. So we want to target the companies in those sectors as well, so that we can become more efficient at being able to get our produce from these countries to the developed countries or continents such as Europe.
Curious to know, what sort of pipeline are you looking at in the immediate, and specifically with a focus on Kenya and East Africa?
Yeah. So we have a very vibrant pipeline, actually, Juliet. We are working with today a business that's in the coffee area. So, coffee and tea have been some of our largest exports as a country for a long time. But we've always exported this as raw commodity as opposed to refined commodity, right? So what we're doing with this company is actually helping them look at their entire supply chain so that we can improve the environmental costs of agriculture. So using of pesticides or fertilizers, how can you improve it so that it becomes a lot more organic in nature, all the way through to the social aspects at the employer, meaning, employee treatment, access to medical health, access to a good working wage, etc. And also helping them move up the value chain so that they can do a lot more processing within Kenya, within our export zones, as opposed to sending raw coffee to the developed markets. So we're working with coffee exporters, we're working with avocado exporters, we're even working with exporters that are involved in the coconut field, right? So it's across the value chain. We continue to look for opportunities also in the mineral area, right? Because Kenya is a big exporter of minerals, but they're going out in raw form. I think there could be a lot more that can be done both on the environmental aspects and the social aspects, and particularly in increasing the value chain within Africa or within Kenya, where we're focusing a lot of our efforts on. And then finally, we're working with an international apparels manufacturer who manufactures products for some of the larger brand names out in the US and Europe. And the idea is to help them set up in Kenya so that we can actually source cotton domestically or locally, which can be made into fabrics for the export market into the US and Europe.
So maybe allow me to push that a little further. So let's say in the next 6 months, how much are you looking to deploy?
We're looking to deploy around $10 million in the next 6 months. And that will be in two businesses that we're in advanced discussions with right now.
Fantastic. Give me some flavor around your ESG matrix when you're doing your due diligence and deal origination. And why I'm asking that is because one of my favorite authors around valuations is a guy called Aswath Damodaran, and he's a skeptic of the ESG. And what he argues is that valuing goodness is not very easy. So when it comes to valuation and pricing, how does it affect? How does the ESG matrix now affect that?
Yeah. So let me give you a practical example, and then we can move on to the metrics, because the metrics can become a little bit theoretical in itself. But if you look at environmental concerns, right, which are quantifiable, if you just pick on environment for an example, and if you just pick the cost of energy, right, if you today are using solar energy within your manufacturing processes, you're bound to save substantial amounts of energy costs on a daily basis. If you within your factory deploy a simple ability to be able to turn on and turn off lights when they're not being used, you will save substantial amount of money. Now that saving translates into higher profitability, direct higher profitability, which in itself translates to higher valuations, right? So that I'm just trying to link you straight from an environmental concern to profits and to valuation, which is why, whilst I've read his articles, I wouldn't say I'm a complete believer in what he says. The same aspects apply to social aspects. It is a proven fact. Factory workers that are taken care of, given a proper minimum wage, which is a livable wage, are highly motivated and can produce more than those that are not paid well or not taken care of, right? That productivity for us results directly in higher profitability, which translates to higher to higher valuations at the end of the day. So in our case, our fund, the way we're approaching the fund is that we're not looking at ESG as a risk mitigant, right? We're not looking at it as a checkbox where we're going to reduce the risk of X, Y, and Z from an environmental, social, or governance perspective. But we're kind of flipping it on its head to say, if you want to improve your revenues, how can you do that applying the right ESG principles? And those right ESG principles could be increase in revenue through ensuring that we are hitting certain regulatory frameworks so that I can sell more in Europe. Am I reducing the cost base so that I can actually improve my profits? Am I improving the social base? So there's a whole metrics that we work across, but our metrics is more around the bottom line as opposed to just a risk mitigation. So the way we focus is we're moving from risk mitigation to value creation using ESG as a key driver for that.
Looking at your intentions within the East African market, one of the challenges, and I'm asking this question because you did mention you also are open to taking up equity stakes in entities. One of the challenges that investors end up facing is exit routes. And it's because exiting via the capital markets has just not materialized on this side. You tend to exit from one fund through another. So does that bother you? And what plans do you have around that?
Yeah, I mean, that influenced a lot of the way we've constructed the fund, and which is why we're uniquely placed on the continent where we can invest across the capital structure, where we work with our partners. It's Kenya, like most of Africa, we have a liquidity issue with exits, and therefore I refer to this concept of risk capital, right? Risk capital means I'm taking equity style risk, meaning I don't have security, or I'm not, senior creditors will be before me, etc. I'm taking equity style risk, and I'm expecting equity style returns. But those returns will be coming through rather than an event of an exit. It can come through, for example, a stock buyback or a loan structure that is slowly repaid to me over time. So there are many ways to actually skin a cat from an equity perspective, where you do negotiate an exit, but it's not dependent on a single event like 100% sale or an IPO, which is the way Africa has traditionally gone. And therefore, we're kind of customizing the products more to the continent than where I would say the traditional funds have come from.
Let's close this conversation. You're coming into a market which is traditionally skewed towards commercial bank financing. And that's understandable, because if you go to the private transaction side, one of the challenges you're bound to face is that the entities which look promising are not investment ready, and they need so much hand holding. So how do you intend to circumvent this challenge before you deploy your capital?
Yeah, so I mean, that's one of the reasons we are really focused on what we refer to as broadly the mid cap, right, where the businesses are already having a significant amount of revenue, meaning about 200, 300, 400 million shillings of revenue. They have a management team and are already to some extent exporting. And in doing so, we will be supporting them, very much focused around the environmental, social, and governance bits. But a core part of our diligence is going to be on the ability of the management to demonstrate to us that they know what they're doing already. So they've passed that initial severe hand-holding stage, but they require our value addition and help around leveraging our know-how in terms of accessing new markets, and in able to access best practices, right? So that's where our competency is. So in our view, we are looking to complement a lot of what traditional venture funds are doing in Kenya already, where they do a lot of the hand-holding for the very young startups, and to a great extent also working with large commercial banks, where they may say, look, here's an interesting business, we're happy to give you senior type loans, but you require a layer of non-secured or some other type of instruments that we can fill up that can help grow these businesses. So to us, this is about creating a partnership with both equity and senior lenders to be able to work with the business in mind and central to this, and using ESG as a way to actually grow that business.